Okay, you guys, going through the investments chapter, we're now going to start with exercise 12-1 on page 708. And here, Tanner UNF Corporation acquired as a long-term investment $240 million of 6% bonds dated July 1st on July 1st, 2016. Okay, you guys, they're buying bonds of another corporation. And corporate bonds are just another way a corporation has of raising capital. They're called debt securities, as we mentioned in the lecture video. And the way those typically work, the issuing company would pay interest to the investor typically every 6 months throughout the bond term. And then at the end of the bond term, they would repay the investors the face amount of the bonds. So it's kind of like an interest-only loan for the term with a full principal payment made at the end of the term. Here we're looking at it from the investment side. We'll look at it from the issuing corporation side in a later chapter. But these, let's read on a little further. The 6% rate is the rate that the issuing corporation is going to pay the bondholders on the bonds. That's called the contract rate. This next sentence is important. Company management has the positive intent and ability to hold the bonds until maturity. Okay, if that's the case, then we're going to classify these bonds as, okay, first off, the investor lacks significant influence over the operating and financial activities of the investee. Just because this investor owns some bonds in the company doesn't mean they have significant influence over operations. We would only deem them to have significant influence over operations if they own 20 to 50% of the common stock of the company they were investing in, or the investee. Or if they own more than 50%, we would say they actually own the company. So the investor lacks significant influence, and the investments are in debt securities, bonds or debt securities, for which the investor, and remember this was crucial in our exercise, has the positive intent and ability to hold the bonds until maturity. They don't tell us the term of the bonds, but they plan on holding them for the full term. Common terms would be 10 years, 20 years, 30-year bonds. Okay, so we're going to treat these as held to maturity investment, and they'll be reported on the balance sheet at their amortized cost. Now, if the fair value changes, it's of no effect if the investment is classified as a held to maturity security. Okay, so let's go back to our journal page. They say the market interest rate was 8% for bonds of similar risk and maturity. So, okay, on the day these bonds were issued, corporations with a similar credit rating, right, or similar risk, they were paying 8% on their bonds, where the bonds that Tanner UNF Corporation bought, that company is only paying 6% on their bonds. And they have essentially the same, we'll call it credit rating. Okay, then Tanner UNF Corporation is not going to be willing to pay full price for these bonds. They're not going to be willing to pay the full $240 million for these bonds, because the investee is paying a rate of interest, 6%, that's lower than the market rate of interest, 8%. Why would they pay the full amount for these bonds when they could go buy another corporation's bonds and receive 8%? So to be able to sell these, the issuing corporation has to sell them at a discount, because the rate of interest they're paying, 6%, is below the market rate for similar investments. So they go on to tell us Tanner UNF only paid $200 million for the bonds, and the bonds have a face amount of $240 million. So they bought them at a $40 million discount. The company will receive interest semi-annually on June 30th and December 31st. It's very common. As a result of the changing market conditions, the fair value of the bonds at December 31, 2016 was $210 million. You guys, held to maturity securities are not reported at their fair value, so that information is just in there to distract you, that last sentence. Number 1, prepare the journal entry to record Tanner UNF's investment in the bonds on July 1st, 2016. So I have 2016 in here. I want to go July 1. So I'm going to debit an account titled Investment in Bonds. All right, and we're going to put the investment on the books at the face amount, $240 million. Your book just, I think, uses maybe 240. I like using the full number. You could put out here in millions if you wanted, but I like using the full number. Okay, how much cash did they pay out for the investment, though? All right, now the investment in bonds, of course, is an asset account, increases on the debit side, and we'll increase it for the face amount of the bonds. To purchase the bonds, the Tanner UNF had to give up cash. Well, that Tanner UNF is a mouthful to me. I'll just go with Tanner or UNF. But anyway, we're going to credit cash. The asset decreased by $200 million. So at this point, our entry doesn't balance. We increased the asset investment in bonds by $240 million. We decreased the asset cash by $200 million. We know that Tanner UNF received a discount when they purchased these bonds because the rate of interest being paid by the issuing corporation, 6%, is lower than the market rate for similar investments of 8%. So Tanner UNF would not be willing to pay the full $240 for the bonds because the issuing corporation is paying lower than the market rate of interest. So they're going to receive a discount. Now, here we have $240 million on the debit side, $200 million on the credit side. So we're going to have to credit discount on bond investment, not band investment. For the difference, and that's going to be $40 million. Which is the face amount minus cash paid. Okay, so there's our July 1st entry. And that's instruction 1, or requirement 1. Number 2, prepare the journal entry by Tanner UNF to record interest on December 31, 2016 at the effective or market rate. Okay, so December 31st rolls around and it's time for the investee to make an interest payment to the investor. Okay, so if the investor is receiving an interest payment, then they're going to debit cash for the amount of cash received. Well, the amount of cash received would be equal to the face amount times the interest rate that the issuing corporation is paying every 6 months. Well, the issuing corporation here is paying 6% per year. So for every 6 months, that's 3%. 6% for a year would be 3% every 6 months. So the amount of cash they'll actually receive would be the face amount times that first rate. The 6% is called the contract or stated rate. 6% for a year, 3% every 6 months. So the amount of cash they'd actually receive is $7.2 million in interest for 6 months. Okay, the credit to interest revenue is going to be made for the amount that the investor paid for the bonds, $200 million, times the market or effective rate for 6 months. Well, the effective rate or market rate for a year was 8%. For 6 months, it would be 4%. That's how much interest they actually earned, even though the interest they received was only $7.2 million. Why? Well, what's happening? Interest revenue earned in future periods is going to be more than the actual amount of interest received, because the investor received a discount on the bonds when they purchased them. This difference will be used to reduce the balance in the discount account over the life of the bonds, so that when the bonds mature, when we run full term, this balance in the discount account would be at 0. So here the discount went on the books as a credit. It would have to come off the books as a debit. Discount on bond investment, or the difference equals 8 million actual interest revenue minus 7.2 million interest received in cash. So we're going to decrease the balance in discount on bond investment by $800,000. What happens is when the investor receives a discount up front, that increases future years' interest revenue. Future periods' interest revenue will be higher than actual cash received for interest because of the discount that the investor received off the top on the day they purchased the bonds. Okay, that takes care of instruction 2. Instruction 3, at what amount will Tanner UNF report its investment in the December 31, 2016 balance sheet, and why? Well, let's go over to the other tab and look at the balance sheet. Now remember from our chart, it's back in the beginning of your chapter, but we'll look at it here. A held to maturity investment, where the investor has the positive intent and ability to hold the investment to maturity, that's going to be reported at its amortized cost. So let's go back over here. This would show up in the assets section, and we'd have current assets first, then investments, followed by property, plant, and equipment. But under investments, we would put investment in bonds at the face amount, $240 million. And when you're dealing with an investment in bonds, we'd show them at their face amount less any unamortized discount. So we're going to show the investment in the bonds at the face amount less any discount on the bond investment that we haven't written off yet. Let's go back over here. We put the discount on the books at $40 million. We've reduced it by $800,000, so it's still on the books at $39,200,000. So it's going to be equal to $40 million minus $800,000. Or $39,200,000. And you guys will call that difference the amortized cost, and that's the number that would be included in total investments and therefore total assets. So we're going to say $240 million minus the $39.2, the discount that has not yet been amortized. So we'd show the bonds at their amortized cost on the December 31, 2016 balance sheet at $200,800,000. Okay, now they go on to ask why these investments in bonds are reported at amortized cost rather than being treated like trading securities or available for sale securities, which are reported on the balance sheet at their fair value. So the reason why is if sale before maturity isn't an alternative, Meaning if the company is not going to sell the bonds before they run their full term, be the term 10 years, 20 years, 30 years, whatever the case may be, then increases and decreases in the market value between the time a debt security, in this case bonds, is acquired and the day it matures. So what they're saying, fair value fluctuations to a prearranged maturity value are relatively unimportant. What they're saying here, changes in the fair value of the bonds, if we're never intending on selling them, we're just holding them until they mature, then changes in their fair value are not important, because we're not looking to sell them ever. It's kind of like if your house goes up in value but you're never planning on selling it. In a way, it really doesn't mean that much to you, right? Might be a poor analogy, but I think you get the point. If they're planning on holding the bonds until they mature, then changes in what they would sell for today or tomorrow are unimportant. They say for this reason, an investor who has the positive intent and ability to hold the securities to maturity investments in debt securities are classified as held to maturity and reported at amortized cost rather than fair value in the balance sheet. You guys, reporting assets at their cost is normal for us. Fair value is what's different. But we're only going to use the fair value reporting on the balance sheet for trading securities and available for sale securities, not for these held to maturity securities. So this is all a part of requirement 3. Now, number 4, suppose Moody's bond rating agency downgraded the risk rating of the bonds, motivating Tanner UNF to sell the investment on January 2nd, 2017 for $190 million. Prepare the journal entry to record the sale. Okay, let's go back to our journal page. Okay, Tanner UNF has decided to sell the bonds, and they sold them on January 2nd, 2017 for $190 million, so the asset account cash increased by $190 million. And we'd also need to remove all other accounts associated with this investment from the books. One of those would be the discount on bond investment. Well, it went on the books as a credit for $40 million. It would come off the books as a debit, but not for the full $40 million. We've already written off part of it here, right? Goes on the books as a credit, has to come off the books as a debit, but the debit would be equal to our $40 million minus the portion of the discount on the bond investment that we wrote off at the end of 2016. So we would debit discount on bond investment for $39,200. Then we're going to credit investment in bonds for the $240 million. And now does our entry balance? Well, we have what, 229,200 on the debit side, 240,000 on the credit side. We need more debit to balance the entry, and we have a loss. Remember, much like expenses, losses increase on the debit side, gains increase on the credit side. The difference is expenses are incurred in the normal operations of the business. A loss would be either an unusual item or it occurs infrequently. We're probably not going to retire an investment in bonds really often. So losses, like we said, increase on the debit side. So I'm going to call that loss on sale of investments. And what do we do here? I'm going to say it's equal to our 240 million minus the 39.2 minus the 190 million, and it leaves us with 10,800,000, the amount of our loss on sale of investments. And that wraps up exercise 12.1. We're going to do another one, exercise 12.2, I believe is next. But we're going to look at some that fall into each of our categories that we've mentioned already. So far we've looked at a held to maturity in debt security investment and the treatment for it. So we'll kind of move on down this list as we go. If you have any questions or concerns, please be in touch. Thanks.